wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 196, and in this episode we are reviewing the performance of the financial markets during the third week of 2026, and that is from Monday the 19th to Friday the 23rd of January. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off with the latest update from the International Monetary Fund, where according to the IMF's World Economic Outlook update for January 2026, global growth is projected to remain resilient at 3.3% in 2026, which is at par with the estimated growth rate of 3.3% in 2025. The forecast marks a small upward revision for 2026 compared with the previous Outlook update that was published in October 2025. This steady performance of the global economy is the result of a balance between divergent forces. On the one side, headwinds from unpredictable trade practices are offset by tailwinds from investments related to artificial intelligence, as well as fiscal and monetary support through accommodative policies and adaptability of the private sector. Global headline inflation is expected to decline from an estimated 4.1% in 2025 down to 3.8% in 2026. The inflation outlook remains broadly unchanged from the October report and projects that inflation will return to its target policy rate more gradually in the United States than in other large economies. Moving over to the Eurozone, Greenland's Prime Minister stood firm on the island's self-governance, saying on Monday that the latest statements from the US, including threats of tariffs, does not change that position. In response to President Trump threatening to hit 8 European countries with tariffs over the issue of Greenland, Europe is reportedly considering bringing out its trade bazooka, which involves imposing 93 billion euros worth of tariffs on the United States. At an emergency meeting in Brussels on Sunday afternoon, France pushed for the European Union to use the anti-coercion instrument, reported by the Financial Times. According to the European Union, the trade bazooka, which is formally known as the anti-coercion instrument, is designed to deter economic coercion that pushes for policy changes that could affect trade and investment in the Eurozone bloc. And over to the second largest economy in the world. On Tuesday this past week, the People's Bank of China, which is China's central bank, decided to keep its loan prime rates unchanged as the government opts to focus on targeted support for specific sectors instead of a broad-based easing of monetary policy. The People's Bank of China held its 1-year and 5-year loan prime rates at 3% and 3.5% respectively, keeping them unchanged for the 8th consecutive month in a row. For your information, the 1-year rate influences new and outstanding loans, whilst the 5-year benchmark affects the cost of mortgages. The decision to hold its policy rate came as the Chinese economy lost momentum in the fourth quarter of 2025 with an annual growth rate of 4.5%, which was the lowest pace of growth since late 2022. And on Wall Street this past week, the Sell America trade was in full swing on Tuesday morning after President Trump and European leaders escalated tensions over Greenland. Additionally, the Danish pension administrator said it was exiting U.S. treasuries to the tune of $100 million, supposedly due to concerns about America's public debt, but more so because of President Trump's threat to take over Greenland. U.S. equities were mixed on Friday as the Nasdaq Composite extended its gains amid easing geopolitical tensions. The three major averages rallied for a second session on Thursday as investors were appeased by news of easing trade tensions and geopolitical risk. The major indices began their rebound on Wednesday after President Trump called off his threat of tariffs on 8 European nations and announced that NATO had reached a framework for a future deal with respect to Greenland. In response, the tech-heavy Nasdaq Composite advanced by 0.28% on Friday before settling at 23,501, whilst the blue-chip Dow Jones Industrial Average fell by 285 points and came to a close at 49,098. Meanwhile, the broad market index, that is S&P 500, eked out a marginal gain on Friday before closing the week at 6,915. In the government bond market, Treasury yields were relatively unchanged towards the end of the week as investors weighed the state of the U.S. economy against a backdrop of easing tensions around trade and geopolitics. Investors' concerns around trade policies and geopolitical risks abated towards the end of the week after President Trump called off tariffs against 8 European countries on Wednesday. This was after the U.S. President and NATO Secretary General announced that they had reached an agreement on the framework for a future deal with respect to Greenland. However, it was a quiet day on the economic data front, with investors looking ahead to the Federal Reserve's policy decision on the 28th of January, in which it is widely expected to keep interest rates on hold, even though markets are still pricing in at least 2 rate cuts in the second half of 2026. The yield on the short-dated 2-year Treasury note dipped by more than 1 basis point to close at 3.598%, whilst the yield on the benchmark 10-year Treasury bond also fell by more than 1 basis point to settle at 4.235%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, crude oil prices rose on Friday after President Trump ratcheted up pressure against Iran through fresh sanctions on vessels that transport its oil and announced that American warships were heading towards the Middle East and are expected to arrive there in the next few days. President Trump has renewed his warning to Iran about its continued killing of protesters or any attempt to restart its nuclear program. The escalation of tensions has raised concerns about disruptions to oil supply from the Middle East. According to OPEC figures, Iran is the fourth largest crude oil producer with an output of about 3.2 million barrels per day and is also a major exporter to China, which is the world's second largest oil consumer. The price of the global benchmark Brent crude rose by 2.8% to close at $65.88 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, this was up by 2.8% and eventually came to a close at $61.07 per barrel. In the precious metals market, the price of silver rose above $100 per ounce for the first time ever on Friday, whilst gold hit another record high en route to $5,000 per ounce as investors pile into safe haven assets amid geopolitical turmoil and on expectations for the U.S. to continue cutting interest rates. Spot silver jumped by 4.5% to above $100 an ounce and surged more than 200% in 2025, driven by ongoing challenges in scaling up the refining capacity for the metal, as well as persistent supply shortages in the market. Since the beginning of 2026, we've seen increased friction between the US and NATO over Greenland and concerns about the Federal Reserve's independence, as well as continued uncertainty over tariffs that have driven a surge in demand for safe haven assets. In addition to that, central bank purchases and a broader move away from the dollar have also driven up the demand for gold. On the U.S. policy front, the Fed is expected to hold interest rates steady in the first half of 2026, but markets are still pricing in at least 2 rate cuts in the second half of this year. In response to the foregoing, the price of spot gold eventually came to a close at $4,976 per ounce. We now change scene to the Kenyan financial markets, and as usual, we start by looking at the domestic foreign exchange market, where the Kenya shilling remains static versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.02. Meanwhile, the sterling pound was priced at 174.15 and the euro was valued at 151.63. And on the regional front, one Kenya shilling was changing hands for 27 Ugandan shillings and 19.64 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.27. The International Monetary Fund has continued to raise concerns about the extreme stability of the Kenyan shilling, but the central bank insists that it continues to operate a floating exchange rate policy. However, the data tells a different story, as the dollar-shilling rate has been stuck between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined significantly by $258 million for a grand total of $12.21 billion, which is equivalent to 5.3 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. But despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka KESONIA, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate was stable at 8.98% and remained in sync with the central bank rate at 9% flat. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 13.7 billion shillings. And for your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 22nd of January, and the central bank received bids totaling to 18.3 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 76%. The central bank ended up accepting 18.2 billion shillings, and the results of the auction were as follows. The 91-day rate surprisingly ticked up by 2 basis points to settle at 7.72%, whilst the 182-day rate dipped by less than 1 basis point to hover around 7.79%, and the 364-day rate remained unchanged at 9.20%. In the secondary bond market, the Central Bank of Kenya was offering bond investors an opportunity to switch their investments from a 10-year bond that matures in August 2026 and to reinvest their funds in a 15-year bond which has 11.3 years left to maturity and matures in April 2037. During the Treasury bond switch auction, which was held on Monday, the 19th of January, the 15-year Treasury bond received bids totaling to 26.4 billion shillings against an advertised amount of 20 billion shillings, representing a performance rate of 132%. The central bank ended up accepting 25.1 billion shillings at a weighted average rate of 13.16% compared to the bond's coupon rate at 13.94%. For your information, the bond switch is a liability management tool that the central bank uses to roll over debt without necessarily having to wait for the bond to reach maturity. Up next is our topical issue, and this week we are looking at two major events that happened in the capital markets. The first is the initial public offering of Kenya Pipeline Company, and the second is the acquisition of a majority stake in NCBA Bank by Nedbank Group of South Africa. And we start by looking at the Kenya Pipeline initial public offering, where the government has officially launched the initial public offering of the Kenya Pipeline Company, marking the largest IPO in the country's history and the first fully electronic public offer. The government is offering 65% of Kenya Pipeline's issued ordinary shares to the public at 9 shillings per share, opening up ownership of one of the country's most strategic energy infrastructure firms to both local and international investors. The initial public offering opened on Monday, the 19th of January, and is scheduled to run for a whole month until the 19th of February. The IPO has been priced at 9 shillings per share and is expected to generate about 106 billion shillings if the offer is fully subscribed. At this price of 9 shillings per share, the total valuation of Kenya Pipeline Company comes in at 163.5 billion shillings. Kenyan investors have been allocated up to 60% of the 11.8 billion shares which the government is offloading in the initial public offering. The Treasury said it has set aside 20% of the IPO for domestic retail and institutional investors. Meanwhile, 15% has been reserved for oil marketing companies operating in Kenya. As for foreign investors, they have been allocated 20%, which is the same allotment given to investors from the East African community. Based on a strict financial review of market multiples and comparable asset valuations on the Nairobi Securities Exchange, the Kenya Pipeline offering appears significantly overpriced relative to current market conditions. The valuation seems to be derived from a cash target approach rather than an intrinsic value assessment, leading to limited upside potential for retail investors. The second topical issue is on the acquisition of NCBA Bank by Nedbank Group of South Africa, where South Africa's Nedbank Group has lodged a major bid to take control of Kenya's NCBA Bank in a deal that marks one of the most significant cross-border banking acquisitions in East African history. Nedbank aims to acquire approximately 66% of NCBA Bank, which currently stands as the third foremost valuable bank that is listed at the Nairobi Securities Exchange. The South African financial giant has already secured binding commitments from its major shareholders, covering over 71% of the stock, a move that significantly increases the likelihood of the deal succeeding as it moves towards regulatory approval. The transaction is designed as a partial tender offer where Nedbank will acquire more than 1 billion shares, and to pay for the acquisition, Nedbank is using a combination of its own stock and cash. For every 100 shares held in NCBA Bank, investors will receive a roughly 4 new Nedbank shares and a cash payment of 2,100 Kenya shillings. This structure values the deal at approximately 1.4 times the bank's book value. Once the deal is finalized, NCBA Bank will officially become a subsidiary of a Nedbank Group. However, the bank will not be fully delisted, as the remaining 34% of shares will continue to trade publicly on the Nairobi Securities Exchange. This acquisition allows Nedbank, which reports massive annual revenues and profits in South Africa, to establish a dominant foothold in the Kenyan financial markets by taking over a bank with a highly concentrated and stable ownership structure. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhurrig@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, your talent determines what you can do. Your motivation determines how much you're willing to do it, and your attitude determines how well you do it. A quote by Lou Holtz. Think about it. Thank you, and God bless.